Sean, welcome.
Nice to be here.
It'd be remiss not to ask you about the RBA. What do you think? Do they have a hike left in them?
I don't think so. We've been saying now for a few weeks, I don't think it's quite a few months, that we don't think the RBA will change all year. I think they're going to stick at 3.6%. They didn't cut last month, and they've had some reasonable, and I say reasonable, not great, CPI news. You know, CPI is now in that 7% mark, down to 7%. It's not 2 to 3%. So if you don't hike last month, the data is improving. Why ever would you hike this month?
Okay, so there is Sean's call, not just this month, for the remainder of the year. So when you think then what that means for equities, because we've been pretty bullish lately. I mean, what does that mean if we see the RBA on pause, even if we start to see other central banks continue to see them hiking?
I think we will. I think the US and probably the ECB will hike again at least once, if not twice. I think the problem you've got to take into account is that equities have had a great run. You know, we've had a huge run over the last 6 months, and a lot of that has been in the tech space on anticipation that, you know, we're going to see peak inflation, peak interest rates, which indeed has played out. It's exactly what's happened. But now, you know, I think we've got the 3-year bonds are showing us historically they tend to lead interest rates, and they're showing us that, you know, it's gone too far. So we can see, you know, 3-year bonds are trading around 3%, interest rates are at 3.6%. I feel like we're going to get too optimistic because there's one thing to say that we're not going to hike for a while. It's a very different scenario to say we're going to start cutting, which some analysts are looking for. I can't see that happening either, hence my call about 3.6 all year, which is probably, it's a bit out there. It's I would almost call it a call with tongue in cheek, but to me it's the logical way for the RBA to play it.
Okay, so we will see lagging monetary policy, et cetera, et cetera. When we talk about what's happening with US equities in particular, we're constantly talking about this tech triumph, this tech revival, you know, top tech saving the indices. Can it continue? I mean, we do have Apple coming later this week, but again, you know, often it's just a few stocks that are leaders of any rally.
It is often, it's not necessarily a good sign. It's actually a sign of weak liquidity underneath the market. So, you know, how we went aggressively long tech in the last quarter of last year. We thought interest rates had done most of their dash, and that's played out really, really well. But in that trade, the long tech trade, we believe is now getting very mature, and it's time to start taking some money off the table, which we've been doing over the last few weeks. And if you look at the chart, which you've got up there now, of 2 of the ETFs, so the top performing ETF, which is the NASDAQ, pure NASDAQ as everyone knows it, is now breaking out to new highs for the year. Looks fantastic. On its own, you'd think, oh, it's off to the races, the recovery is there. But if you then look at the ETF, which is equally balanced across the portfolio, as opposed to putting the extra weight for the large caps, as you mentioned before, it's a very different story. They're not yet anywhere near the highs of the year. And that tells me the internals of the market aren't so good. The tech side of things, it's a great sign for it that it's tired, and that just quite simply, as I said before, to us the risk reward is about migrating more to a neutral stance towards the tech side of things. Capital inflows into tech were huge last month. People are all getting bullish tech again. We think it's time to take some money off the table.
Okay, so if you're taking money off the tables, where do you put it? I mean, where do you see opportunities now?
Well, it's not quite going under the bed, but we have increased cash slightly. Give a bigger picture view. In December, we had only 1% in cash in our flagship growth portfolio. Now we're back up to about, I think it's 11% this morning. So it's quite a big increase in cash. We're a fairly active portfolio, so we might put that to work in the next week or 2 weeks. We're pretty open-minded. But we feel that the recession trade is gathering a bit of momentum. I saw you mention in comments about the US dollar. I think the US dollar is starting to bounce. If it bounces back up to that 105, 106 area, the likelihood is that it will weigh on the resource stocks a bit, the miners, and that's where we would like to allocate the money into a bit more weakness.
Okay. I will push the point. So lithium, gold, iron ore, prices are depressed, coal. I mean, is there a general sector that you are watching with more interest in the commodity space?
Well, I'm looking at all of those. So we are long gold. We're overweight gold. We're long Newcrest. We're long Evolution. I've been saying that to you for a long time. We're not changing that. Do I think gold can pull back a bit? Sure, of course it can. It's gone a long, long way. If the US dollar bounces to 105, 106, we might well see that unfold. But we're staying long gold. We believe that is a great trade for the coming years, and we don't want to lose that position. Lithium is a lot more volatile play. We are long Pilbara now. But again, 5-10% swings in that market, they happen a bit like the sun coming up in the morning. So we're happy with the thematic. We're happy to be long, but we're not aggressively long. I'd be more focused on looking at the diversified plays. A stock like South 32 came out with a pretty average result recently. If that sees further downside, that might catch our attention.
Okay.
So we wouldn't be quite so specific about saying we're going to go all in with iron ore or all in with lithium. I'd pick a quality diversified miner.
Okay, South 32, and it did get beat up last week in the wake of its production report. We've got the banks reporting, ex-CBA. Any interest there? Keeping it nice and topical today, aren't we? Yeah.
Yes, I think that we're long NAB, ANZ and Macquarie. Okay, and probably the most common questions we've had at Market Matters over the last coming weeks is, should I take profit now on this? Should I take profit now? It's always been banks. People are overweight the banks. The average retail investor in Australia is overweight the banks, as we mostly know. We think we're mildly underweight the banks, and only just, because we think their margins are contracting slightly. There's been an aggressive push to increase the consumer base. We've all been seeing the adverts on TV and the adverts in the media, etc. So we just want to see how that plays out. We wouldn't be taking profit or or adding to our position unless we saw a 10% swing. I can see them going sideways for a while, giving great yield. Happy to stay there. Let's obviously wait and see what they deliver. ANZ is still the cheapest. It's and the highest yield. It looks like a great valuation story going forward. Macquarie is where the growth could be. The commodities area is obviously very important going into their report on Friday. So I think you have to keep long the banks. We've got a little bit of ammunition to buy if one of them disappoints and we think the market overreacts.
Okay. Why NAB? What's the attraction to NAB?
NAB is the one that we're long, and I know some of the other brokers out there aren't as attracted by it. We just think it's a solid all-round bank. We were long CBA for the last 2 or 3 years, which gave us some phenomenal return. But we just felt that ANZ and NAB produce better value, simple valuation metrics. And
Macquarie, so we normally don't talk about it in context of their home loan growth, but we're continually sort of being batted over the head with the advertisements and then the subsequent commentary that it is actually making some pretty significant inroads in there. Or is it still the investment banking, still the commodities side of the business that is attractive, even if we're facing an economic slowdown, potentially even recession in the States?
Yes, well, I think we probably will see a technical one. It's hard to imagine one here at the moment with 50-year lows for unemployment, even if some people are.
And the RBA on pause for the rest of the year.
Yeah, but we are. If we're right, I'll quote that in December if we are right. But I think overall, you've just got to be a little bit open-minded to which way the banks are going to move and how they're going to move, going forward. Just keep it flexible.
Okay, well, we will learn a lot in the next, a few trading days once we get past some of these big central bank meetings. The first one up at 2:30 p.m. today. Do you expect to see a bit of a relief rally in the equity market if we do see the RBA on pause, or is it fully priced?
The actual comment, no change, is fully priced in. The rhetoric is very, very important. I've got no doubt they'll try and keep the gate open for another rate hike down the track if they need to. Again, they'd probably be mad if they don't. They've got to be flexible. They've got to be open-minded because they got it wrong first time by leaving it too late to hike. Then they've arguably hiked too fast to try and make up for things. They don't want to get it wrong again, which is why I think they might sit in their hands for a while and just see these numbers come through. They'd have been happy with last week's numbers, the inflation numbers of last month. Let's wait and see what comes on. So I think the market will pop up mildly, but I think the rhetoric's more important than the announcement, assuming it's unchanged.